The current market status for Arista Networks Inc., trading under the ticker ANET on the New York Stock Exchange, reflects a closing price of $136.34 USD as of the final bell on Friday, January 23, 2026. Today is Sunday, January 25th, 2026, so the market is currently closed, but this price represents a dip of 1.50% or a decline of 2.07 points during the most recent active session. While a minor drop like this might seem like standard noise in a volatile tech sector, the reality beneath the surface is far more complex than a simple daily fluctuation. Most investors are looking at this price action and seeing a cooling off period after a massive multi-year run, but the expectation that Arista is merely a cloud switch company is about to be challenged by a much deeper structural shift in how data moves. While the general market narrative suggests that the massive infrastructure build-out for artificial intelligence is starting to reach a saturation point, the underlying data tells a different story. We are entering what many top-tier analysts are calling the year of the refresh. The curiosity loop here is not about whether companies are still buying hardware, but rather which hardware is becoming the indispensable backbone of the next stage of computing. Many people assume that NVIDIA stock has dominated the conversation. The networking side is just a secondary concern. However, the reality is that without the massive throughput provided by Arista's 800G and upcoming 1.6T Ethernet platforms, those high-end chips are essentially stuck in a traffic jam. This creates a fascinating tension. The expectation is that Arista is vulnerable to a slowdown in capital expenditure from its biggest customers like Microsoft and Meta. The reality is that these cloud titans are actually shifting their focus from just buying more chips to upgrading the literal pipes that connect them. If you look at recent institutional activity, you will see a tug of war. We've seen some notable insider selling lately, specifically from engineering leads like Kenneth Duda, which often spook retail investors. But at the same time, firms like Piper Sandler have recently upgraded the stock, pointing to a massive wave of network refresh cycles coming in 2026. They argue that hyperscalers are facing severe bottlenecks and must prioritize networking upgrades to actually utilize the processing power they've already paid for. When you look at the broader landscape of online investment, many people are turning to investing sites and apps like the Robinhood app or Fidelity to find the next big winner in the AI space. But often, the most stable investment lies not in the flashiest name, but in the most essential one. Arista Networks has quietly become that essential name. If you're using SoFi Invest or Interactive Brokers trading platforms to manage your individual brokerage, you've likely noticed that ANET has been a staple in high-growth tech portfolios for years. Its performance, up over 330% in the last 3 years, speaks to a business model that is incredibly disciplined. The immediate pressure on the stock right now stems from a few factors. First, there's the valuation. With a PE ratio hovering around 52, it's not cheap stock by any means. When investors see a 1.5% drop on a Friday, the fear is that the AI premium is finally eroding. But look at the margins. Arista is maintaining gross margins in the mid-60% range, which is almost unheard of for a hardware-centric business. They are achieving this through their extensible operating system, or EOS. This is a single image of software that runs across all their devices, making it incredibly easy for a giant like Oracle or Microsoft to manage a massive data center. It's the ultimate sticky product. Once a company integrates EOS into their workflow, the cost of switching to a competitor is prohibitive. Comment below how many shares of Arista Networks you currently hold, or let me know if you are waiting for a deeper pullback before adding to your position. The recent trading volume, over 8 million shares in the last session, indicates that big players are repositioning. We are seeing a rotation away from pure-play semiconductor companies into the infrastructure layer. This is where investment help and self-investing strategies often diverge. A casual observer might see Arista as just another hardware vendor, but a smart investor using a Fidelity trading platform or a Robinhood stock trading strategy looks at the deferred revenue. Arista recently reported nearly 4.7 billion USD in deferred revenue. This is a massive backlog of guaranteed future income that provides a safety net most tech companies would kill for. Let's talk about the competition for a moment, because this is where the expectation versus reality dynamic gets really interesting. The common belief is that NVIDIA's Spectrum X platform is a direct threat that will eat Arista's lunch. The reality, however, is that the industry is largely pushing for open standards. Ethernet is an open standard. NVIDIA's InfiniBand is more proprietary. While NVIDIA is definitely a formidable competitor, the big cloud providers are wary of being locked into a single vendor's ecosystem. They want the flexibility that Arista provides. This is why Arista is targeting $2.75 billion in AI-specific revenue for 2026 alone. If you're into online investing, you might be familiar with Schwab Intelligent Portfolios or other robo-advisors that use an intelligent portfolio approach to balance risk. These systems often include names like Arista because of its zero debt balance sheet and massive cash reserves, currently sitting at over $10 billion. This financial strength allows them to make strategic moves, like their recent acquisition of VeloCloud or their deepening partnership with Anthropic. They aren't just reacting to the market, they are actively shaping the enterprise networking landscape. What does Arista actually do? At its core, it designs and sells high-performance multi-layer network switches. But that's like saying Apple just sells phones. Arista's real product is the software that makes those switches intelligent. They pioneered the SDN, or software-defined networking approach, which moved the intelligence out of the hardware and into a programmable software layer. This was the original disruption that allowed them to take massive market share from legacy players like Cisco. Today, they are the undisputed leaders in the high-speed switching market for data centers. Looking back at past performance, Arista has consistently beat earnings expectations. In the last report, they posted a revenue beat with 27.7% year-over-year growth. This is incredible for a company of this size. However, the market reacted with a slight pullback because management gave a conservative guidance for 2026 operating margins, projecting them to land in the 43 to 45% range. This is the classic tension I mentioned. The market wanted to hear that margins would stay at peak levels forever. Management, being professional and realistic, pointed out that a shift in product mix, selling more to cloud titans who have massive bargaining power, would naturally compress margins slightly. This brings us to the future outlook. As we move through 2026, the catalyst to watch is the adoption of 800G Ethernet. This isn't just a minor speed boost, it's a requirement for the next generation of large language models. If the adoption rate exceeds expectations, Arista could see a massive re-rating higher. On the flip side, the risk remains in customer concentration. When more than 50% of your business comes from a handful of companies, any change in their spending habits is a major headwind. For those using a Fidelity brokerage or a SoFi trading platform, the decision on ANET usually comes down to your time horizon. In the short term, the stock is fighting against high expectations and a premium valuation, but in the long term, it is the premier play on the physical reality of the internet. Whether people are using Robinhood crypto features or traditional Fidelity ETFs, the data that fuels those transactions has to travel through a switch, and more often than not, that switch has an Arista logo on it. Investors often search for investing sites or invest online options to find something that can offer a balance of growth and stability. Arista fits this profile perfectly because it behaves like a growth stock but has the balance sheet of a blue chip. Its ROE, or return on equity, is over 30%, showing that management is incredibly efficient at using shareholder capital to generate profit. This is why you see it as a top holding in many Fidelity mutual funds and Fidelity wealth management strategies. As we wrap up this look at Arista Networks, let's summarize the central insights. The expectation is that the AI boom is cooling, and Arista is at the mercy of its largest customers. The reality is that we are on the verge of a massive refresh cycle, where networking becomes the primary focus of capital expenditure. While the stock sits at $136.34 and has seen a bit of downward pressure, its fundamental story, driven by 800G adoption, $10 billion in cash, and an industry-leading software stack, remains incredibly robust. The contrast between what the market fears and what the data shows is where the opportunity lies. Those who understand that Ethernet is the future of AI clusters will see this current volatility as a natural part of a long-term uptrend. Arista has spent years building a moat that is very difficult to cross, and as they move into 1.6T speeds and deeper enterprise integration, that moat is only widening. Whether you're managing a self